$3,088 million. That's what TD Bank agreed to pay in October 2024, the largest Bank Secrecy Act settlement in history. But the dollar figure isn't even the most significant part of this case. TD Bank pled guilty to a felony conspiracy to commit money laundering, the first bank in U.S. history to do that. Not a fine, not a consent order, a guilty plea to a felony, admitting the bank itself conspired in the laundering. I'm a CAMS-certified financial crime investigator with over a decade in this field. Everything covered on this channel so far has been a money services business, a money transmitter, a crypto exchange. This one is a full-service American bank, with branches, deposit accounts, and $1 trillion in assets. Here's exactly how a bank that size ends up pleading guilty to a felony. Start with the scope, because it's almost hard to describe without sounding exaggerated. From January 2014 to October 2023, nearly a decade, TD Bank failed to maintain an anti-money laundering program that complied with the Bank Secrecy Act. According to the Department of Justice and FinCEN, roughly 80% of the bank's transactions during parts of this period were not being screened for suspicious activity at all. Not screened poorly, not screened. That's trillions of dollars in transaction volume moving through a major U.S. bank with a monitoring system that, for the majority of activity, simply wasn't looking. This is the detail that separates TD Bank from a bank with an imperfect program. This is a bank where the screening function itself was failing at the transaction volume level, not just missing edge cases. The settlement resolved investigations by 4 separate authorities at once: the Office of the Comptroller of the Currency, the Federal Reserve Board, FinCEN, and the Department of Justice. TD Bank agreed to $1.4 billion in fines to the DOJ, plus $452.4 million in criminal forfeiture, the largest forfeiture ever imposed under the Bank Secrecy Act. FinCEN separately imposed a $1.3 billion civil money penalty. Add it together and you get just over $3 billion, split across 4 regulators who each found the same underlying failure from a different angle. Here's where the case moves from a compliance program failure to something closer to an inside job. Between 2019 and 2023, 3 separate criminal networks collectively moved more than $670 million through TD Bank accounts. And they didn't just slip past an imperfect monitoring system. They had help from inside the bank. The largest network was run by a man prosecutors identify as Da Ying Si, known as David. His network moved approximately $474 million through TD Bank by depositing cash directly at TD branches across New York and New Jersey. To keep the scheme running smoothly, David bribed TD Bank employees, prosecutors say with more than $57,000 in gift cards, specifically to ensure those employees kept processing the network's transactions without asking questions. David eventually pled guilty to coordinating a $653 million money laundering conspiracy, operating an unlicensed money transmitting business, and bribing bank employees. One of those bribed employees was Wilfredo Aquino, a TD Bank employee in New York. Aquino personally processed approximately 1,680 official bank checks for David's network, totaling more than $92 million. In exchange, prosecutors say, Aquino received gift cards worth over $11,000, just over $11,000, to move $92 million. A second network, involving a different bank employee, Leonardo Ayala, worked differently, but told the same underlying story. Ayala accepted bribes and used his position inside the bank to open fraudulent accounts and issue more than 150 debit cards tied to shell companies. Those cards were then used for more than 12,000 ATM withdrawals in Colombia, funneling approximately $5.5 million in drug proceeds out of the United States. Every case in this channel's enforcement series up to this point has been about a program that existed but didn't work fast enough, or agent oversight that didn't keep pace with risk. TD Bank's case includes that same category of failure. The 80% unscreened transaction rate is a program design and resourcing failure, full stop. But the bribed employee detail changes the nature of the problem, because no amount of transaction monitoring software fixes an employee who is being paid, in gift cards, to personally push transactions through regardless of what any system flags. This is the reason background checks, employee conduct monitoring, and internal whistleblower channels are as much a part of an effective BSA program as the transaction monitoring engine itself. A monitoring system generates an alert. A person decides what happens next. If that person has been compromised, for $11,000 in gift cards, in Aquino's case, the alert doesn't matter. TD Bank's program had both problems simultaneously: insufficient monitoring at scale and insufficient controls over the employees positioned to override what monitoring existed. The size of the institution is also part of the story here, in an uncomfortable way. A bank processing the transaction volume TD Bank processes needs both automated screening that actually covers the volume and human oversight of the employees closest to cash handling. When 80% of transactions go unscreened, the automated layer has essentially failed. When employees are taking gift card bribes to keep suspicious accounts open, the human layer has failed too. Neither layer is a backup for the other. They're both required, and TD Bank's case shows what happens when both give way at once. Beyond the $3 billion in combined penalties, FinCEN's resolution requires TD Bank to retain an independent compliance monitor for a 4-year term, at the bank's own expense. The same structural remedy used against MoneyGram and Western Union in earlier videos in this series, scaled to the size of a top 10 U.S. bank. The guilty plea itself, to a felony conspiracy to commit money laundering, is the detail that will likely define this case in enforcement history, regardless of how the dollar figures compare to future settlements. No bank had pled guilty to that specific charge before. TD Bank is the first. Individual accountability followed the institutional resolution. Multiple individuals connected to the case, including David and the bank employees who took bribes, faced separate criminal charges and pled guilty in their own right. A reminder that a corporate settlement doesn't shield the individuals who personally facilitated the underlying conduct. If you're running a financial institution of any size, bank or MSB, the lesson from TD Bank isn't really about the size of the fine. It's about the specific combination of failures that let this go on for years: automated monitoring that didn't cover the actual transaction volume, and no effective mechanism to detect an employee who's being paid to look the other way. Test both, separately. Confirm what percentage of your institution's transaction volume is actually being screened in practice, not just what your policy says should be screened. TD Bank's policy presumably said 100%, and the reality was 20%. And build an actual mechanism, not just a code of conduct clause, for detecting employees whose behavior around specific accounts or customers doesn't match their role. Unusual account openings, unusual override patterns, unexplained relationships with high-volume customers. Those are testable, specific things an independent program review can check for, and they're precisely the gap that let a $57,000 gift card scheme move $474 million through one of the largest banks in the country. $3 billion, 4 regulators, 3 criminal networks, and a guilty plea that had never happened before at this scale. TD Bank's case is the largest number this channel has covered, and the mechanics underneath it, unscreened transaction volume plus compromised employees, are the same 2 failure points worth testing in any institution, regardless of size. I'm a CAMS-certified financial crime investigator with over 12 years in this field, and I built 4th pillar compliance to test exactly these gaps before a regulator or a prosecutor does. Program reviews, red flag testing, and interim BSA-officer support, built around the failure points that actually show up in real enforcement actions like this one. I left the same free red flags checklist in the description. If you want to understand how these cases actually get built, not the headline, the mechanics, subscribe. Educational only, not legal advice. Everything here from public court filings and regulator press releases. I'll see you in the next one.